how does Dynasty help founders get more of a benefit?
We help you get more QSBS by giving some of your shares to family members in trust. So if you have children, you have a spouse, parents, siblings, whoever you want, you can gift some of your shares into a trust for a family member, and that trust will then get its own separate QSBS exemption. So our standard package is 4 trusts for $1,500 a year. That gives you an additional $40 million in QSBS eligibility.
So you go from 10 million in tax exempt gains to 40. Is there a max?
10 to 50 because you already have your 10.
Wow.
Yeah, so you add on 40. And that's for the old rules. The new rules, you're going to get an additional $60 million in QSBS eligibility. There is no max. There's a very famous example of this. The founder, CEO of Roblox, it was written about in the New York Times, created 12 trusts, got $120 million in tax-free capital gains. The IRS does have a rule around creating too many identical trusts. So we usually say, if you're going to create these, that's what our package is for 4 trusts. We think that's a very safe number to do. If you want to do more than that, then we have a lawyer package. We'll add on a lawyer as part of our offering, and you can talk with them and discuss the legal risks of having way too many of the same exact type of trust. That's how I learned about QSBS stacking, because when we were onboarding thousands of cap tables, we saw that there's a very small percentage, 5% of founders have 4 or 5 trusts, and we're like, what's going on here? Are they just being generous? But it wasn't until a good friend of mine, one of the early investors in Carta, told me that they set this up, got $30 million in tax-free capital gains, sold the stock, and they were using the money to buy houses, and they don't own the house, but they live in the house and they pay rent. And so when I heard that, I was like, that is crazy. Why don't all founders do this?
All right. Welcome, everybody, to the Startup Growth Podcast. We have a very special guest today. We have Alessandro Chesser, the founder and CEO of Dynasty, the startup that saves startup founders millions of dollars in taxes through QSBS trust stacking. Thanks so much for joining us.
Thanks for having me on the show.
Yeah, so excited to jump into things. So Alessandro started his career in finance way back in the day in banking, and then as he went up in his career, he was head of sales at Carta from 0 to 300 million in ARR, and now just recently started Dynasty. So excited to jump into all these parts of your journey, and would love to just start with the big beautiful bill that made all of our lives a little different, specifically for startup founders. So yeah, what is the latest on? Well, maybe first tell us, what is QSBS?
Qualified small business stock is the greatest tax exemption that exists. It allows startup shareholders with qualified stock to sell between $10 and $15 million in capital gains and pay 0 taxes. What other I remember when I learned about QSBS, it was an old friend of mine who was a PwC accountant. He's like, where else do you have the opportunity to pay 0 taxes on a $15 million capital gain? It doesn't exist, right?
That's insane.
Greatest tax exemption that exists. It's unfortunate that a lot of employees and founders still don't even know about it, though.
Yeah. So when did it start? It's been around for decades, right?
The early 1990s. The purpose of QSBS, Qualified Small Business Stock, is to incentivize investors to invest in startup companies. That's the whole purpose. More investors investing in startups means startups can hire more employees, means more successful outcomes. And the hope is that that money is then reinserted back into the ecosystem. Mm-hmm. It creates a cycle, more money going into startups, create more successful outcomes, create more startups and more investors in the future. So it just creates a cycle.
And so basically, if you own shares in a qualified small business stock, what is the criteria? Is every startup a QSBS company for the most part?
Most startups qualify. I would say it's probably 95% of startups qualify. There are some startups that don't qualify. So there are some tests you have to meet. Number one, you have to acquire the shares before the company has $50 million in gross assets on the balance sheet. So for early employees and founders, especially and angel investors, everybody gets their shares before the company has $50 million in assets. And I'm going to kind of go back and forth because there's old rules and then new rules. You mentioned the big beautiful bill. So the new rule is 75 million. That's the asset limit. But the new rule is only applicable for companies that are issuing shares after July 4th of this year. That's the date of the big beautiful bill. So going forward, everybody's subject to these new rules. For most of the people listening to this, most of your audience, they're going to be subject to the old rules. So I'm just going to refer to the old rules for the most part. So the tests are, you have to acquire the shares before the company has $50 million in gross assets. The second test is you have to hold the shares for at least 5 years before you sell. That's a very important one. People that hold their shares for 4.5 years and then sell their company, they don't qualify for QSBS. And so those are the two most important ones. There's also, certain criteria that depends on what type of company you are. If you're in a regulated industry, for example, certain types of lending businesses typically don't qualify. If most of your revenue is services related, you're not going to qualify. So this is really set up for like technology companies specifically, and you have to be a U.S. C-corp as well to qualify.
Amazing. So 50 million or less in assets when you get your stock. So I know a lot of people are like, is that the valuation or is that the gross assets? It's the cash in the bank. If you get your stock when there's less than $50 million in the bank, that passes the test, right?
That's right. For the most part, it's just your cash in the bank. You can also include like intellectual property. Most startups don't really have a ton of that, but if you do and it's valuable, then it's worth getting an opinion on the validity of your QSBS shares. And like if anybody, like I said, who acquired the shares, now all founders qualify because everybody gets their shares before there's any money at all in the balance sheet. The balance sheet test is really more applicable for like later investors and employees that come in, after the company has $50 million in assets.
Yep. And so, so this is a huge benefit to all shareholders. So early employees, investors, founders, and basically if you don't qualify, right? So the status quo is basically, let's say your shares are worth $10 million when the company sells. You sell that $10 million are proceeds to you as the shareholder. You pay, maximum taxes across the board, California, federal. So you're going to end up paying,
almost
maybe
40%.
Almost 40, let's call it 40%. So you're going to spend $4 million in tax. So you net $6 million. What's new or what this is saying is that 10 million is on qualified small business stock. So that is actually going to be, instead of paying 4 million in taxes, you're going to pay nothing.
Federal, you're going to pay nothing. And then depending on what state you're in, if you're in 45 out of 50 states, you're going to pay nothing at the state level as well. Very good example is New York. New York is a high tax state, but New York recognizes QSBS. So if you live in New York and you have qualified stock, the first $10 million in gains, you're going to pay 0 taxes.
Wow. So that's a pretty valuable takeaway. If you didn't know that and you're listening to this, you could save millions of dollars just from having qualified small business stock for 5 years.
That's right.
So just wait 5 years before you sell.
You wait 5 years and live in the right state.
And live in the right state.
California, unfortunately, does not recognize QSBS, so you still have to pay the state taxes.
Yep.
So on the $10 million gain example that you have, you'll still pay about $1.3 million to California, but the rest will be 100% tax-free.
Yeah, the other $2 million and some change you're going to save.
This is the only situation where it makes sense to move from California to New York for tax purposes, because New York does recognize QSBS, so it's a huge hack.
That's a huge hack. And you mentioned that the big beautiful bill kind of changes this. So we talked about 5 years, waiting 5 years. But now with the big beautiful bill, if you're getting this stock after July 4th, that's changed a little bit. So now you can wait, I think, is it 2 years or 3 years, and you start getting some benefit?
You can start getting QSBS eligibility based on the new rules for shares issued after July 4th of this year. You can start getting eligibility at the 3-year mark. You can become 50% eligible. At the 4-year mark, you're 75% eligible. And then at the 5-year mark, you're still 100% eligible.
Wow. Okay, amazing. All right, so now we're on the same page. We love QSBS. So how did you get into QSBS? Would love to hear your story.
Yeah, I mean, it's funny. I was one of the early employees at Carta, eShares. And, when we were 15 employees, we were all in a conference room, and one of the individuals that we hired was a former PwC accountant. And he told me about QSBS. So I brought it up. In the company meeting. I'm like, hey, does anybody know about this QSBS? And some of the senior leaders in the company, including the CEO, and including our general counsel said, no, that's not right. There's no way, that doesn't exist. And so this came down to like whether or not we were, we were talking about exercising our shares, because that's how you start the clock. If you have options, you have to, the clock starts when you have the shares in your hand, not the options. So if you have options, you actually have to exercise them to start that 5-year clock. And so that was the conversation we had in that meeting, was like, if QSBS is real, then we need to exercise immediately. And so that was the advice that I was getting from the PwC accountant. But, our general counsel and our CEO, they were being cautious, and they told us not to exercise because they didn't want, it's risky at that point. Carta was, pre-Series A, and they didn't want us to actually pay the money. Companies like, maybe it's going to work, maybe it's not going to work. And so they also never heard of QSBS and didn't believe it was actually real. So they were like, don't exercise. Like, listen, this is risky. And it was out of the goodness of their heart. They weren't doing it intentionally to make anybody choose the wrong decision. But me, on the other hand, I listened to the PwC guy, even though he was like 23 years old. Like I was confident that so I exercised all my stock and I got QSBS eligibility. It wasn't until later that we actually found out that it was true. I got to benefit. Our general counsel did not. He didn't get to benefit. It was very unfortunate. A lot of other early employees also did not exercise, so they didn't get the benefit.
How do you go about early exercise? Is that a certain way that the the options have to be issued, or can anyone early exercise?
It's very important when you're going to join a company. If you're going to get options, you should ask, do they allow for early exercise? And this is only important if you actually believe in the company. If you believe in the company, you should exercise from day one. If you end up only working there for 1 year out of the 4-year vesting, your shares are going to get repurchased anyways. You're going to get the money back for that exercise. But that will start the clock for QSBS. But also it starts the clock for long-term capital gains. And it also avoids the ability for you to actually have to pay alternative minimum tax as well. See, the problem is when you hold your options, I didn't exercise all my options at Carta. Some of them I waited, and they're still outstanding right now. I can't afford to exercise them anymore because the gain on that, with the second I exercise them, I'm going to get a $500,000 tax bill. Wow. And it has due immediate, that's alternative minimum tax. And with no liquidity, there's no reason for me to exercise those shares, right? I just can't afford it. I can't afford to do that.
Wow. So, okay. Can we talk a little bit more about that? Because I think that's always really confusing for a lot of people. So you get issued stock options, right? So let's say you get 10,000 shares, you have a strike price of 1 penny. So that's going to cost you, what's 1 penny times 10,000? I don't know. I'm bad at math, $10 or something.
$100.
$100. Okay. So $100. And if you early exercise, you pay that $100. And early exercising, I'm guessing the value is $100 and you're paying $100. So there's no gain.
No gain.
Okay. But if you wait 5 years and now that those options are worth $1 million and you exercise for 100, you have to pay on the gain.
9.9 million. Yeah. And
you'd pay 9.9 million.
You're going to pay taxes on that gain. That's right.
Wow.
And so you have to pay alternative minimum tax. And so that's the reason why, if you do it from day one, when you get the shares, there's no gain. You don't have to pay that alternative minimum tax.
Wow. So that's really important. Exercise early if you can.
If you believe in the company.
Yeah.
Absolutely.
And so there's another part of this. So we talked about sort of exercising your options and AMT, the QSBS qualification. This other part is somewhat related. It's like the 83B as a founder. So the 83B is an election you make the year that you get your startup stock as the founder. It needs to be filed within 30 days of incorporation, something like that?
I think it's 30. I don't know the exact
30 or 60 or something like that. I think it's 30. And if you don't do that, you kind of end up with the same AMT problem.
You're not going to start the clock.
You're not going to start
QSBS either. And taxes will be due.
So you have to, so this is really important too. You have to file your 83B within the required time frame, which I think is 30 days of getting your shares.
I talked to one founder who didn't do that. He gets no QSBS.
Wow. So remember to file your 83B.
Yeah, and law firms are usually pretty good about this. Carta has a feature to do it as well. It's so important. I don't think enough people don't talk about it. But, YC does a really good job, with their founders and their batches. They literally hold their hands to help them get their 83Bs filed. It's a very important thing to do.
Yes. Awesome. Okay. So 83B must have,
Must have.
must get your shares when you have less than 50 million in cash in the bank and hold it for 5 years. And now you get a $10 million gain, completely tax free. So, okay. So that is like pretty amazing. And now with this new bill, okay, it's increased to 15 million and you can get your shares when there's less than 75 million in assets. So what is Dynasty doing here related to this, right? Because this is without Dynasty. So without Dynasty, you get, this $10 million thing. So how does Dynasty help founders get more of a benefit?
We help you get more QSBS by giving some of your shares to family members in trusts. So if you have children, if you have a spouse, parents, siblings, whoever you want, you can gift some of your shares into a trust for a family member, and that trust will then get its own separate QSBS exemption. So our standard package is 4 trusts for $1,500 a year. That gives you an additional $40 million in QSBS eligibility.
Wow. So you go from 10 million in tax exempt gains to 40. Is there a max?
10 to 50 because you already have your 10.
Wow.
Yeah, so you add on 40. And that's for the old rules. The new rules, you're going to get an additional $60 million in QSBS eligibility. There is no max. There's a very famous example of this. The founder, CEO of Roblox, it was written about in the New York Times, created 12 trusts, got $120 million in tax-free capital gains. The IRS does have a rule around like creating too many identical trusts. So we usually say, like, if you're going to create these, like, that's what our package is for 4 trusts. We think that's a very safe number to do. If you want to do more than that, then we have a lawyer package. We'll add on a lawyer as part of our offering, and you can talk with them and discuss the legal risks of having way too many of the same exact type of trust.
Oh, interesting. And so, okay, so before Dynasty, you had to what was the status quo to do QSBS trusts?
So the old way of doing this, and one of my early investors at Carta actually did, and that's how I learned about QSBS stacking. Because when we were onboarding like thousands of cap tables, like we saw that there's, a very small percentage, 5% of founders had like 4 or 5 trusts. And we're like, what's going on here? Are they just like being generous? But it wasn't until a good friend of mine, one of the early investors in Carta, told me that they set this up, got $30 million in tax-free capital gains, sold the stock, and they were using the money to buy houses, and they don't own the house, but they live in the house and they pay rent. And so when I heard that, I was like, that is crazy. Why don't all founders do this? And, they told me it's cost them over $100,000 to set it up. And the annual maintenance fees were like $25,000 a year. And so that's when I was like, this needs to be productized. And I didn't actually have this idea to start this company. It was actually a friend of mine who was running strategy at the time at Carta. He put it all together in a memo, and he's like, Carta needs to do this. We need to create this product. And it was my aha moment right away. I was like, this is a good idea. And so I pushed for Carta to build it. Carta was never going to do it. It's way outside of Carta's wheelhouse. There's way too much, right? Carta's figuring out all the other businesses that Carta's working on, right? Secondary markets and venture fund administration, private equity now. It's like going all these different directions. They were never going to do this. And so me and my 2 co-founders, we left Carta and we're like, what should we do now? And I brought this idea back up with the individual that actually came up with the idea. And he was like, you should do it. I'll invest right now. And so that basically kicked off the company.
Wow, that's amazing. And so, so when did you officially start?
April 2021.
Nice. Wow. Okay. So now you're continuing to build Dynasty with your founders. You're based here in SF.
Based in SF. Yep.
Amazing. And so, how much does it cost? How do people get started?
Yeah, $1,500 a year gives you up to 4 trusts. We cover trust creation. We handle annual trust administration. Plus, we file the tax returns for each of the trusts. So it's like less than 5% of what it normally costs doing it the old-fashioned way.
Wow.
And we do, our business model is very cheap up front when you're a early stage startup company. We priced it in a way where it makes sense for startups. Like the earlier you do this, the better, because there's gift tax implications. Like you want to do it when your shares are worth nothing. That's the best. And the longer you wait, the more valuable your shares become. Now you're limited because you can only gift up to $14 million in your lifetime without paying inheritance taxes. And so like if your company's now worth $100 million and your shares are worth $20 million, you're kind of limited in what you can do. And you have to use up your entire lifetime exemption. Like once you use it, you lose it. You won't be able to give to your children in the future. You won't be able to create these trusts later. So like day one, when you form your company, that's the ideal time to set this up. And we priced our product in a way where it could make sense for a day one founder. I think we have a very small percentage of our customers that come in that way, like right before they form their company or right after they form their company. That's the ideal time.
Wow. Yeah, that's pretty incredible. So for $1,500 a year, you can potentially get $50 million in tax exempt gains.
That's right. It's small downside. It's your fixed cost, $1,500 a year, but it's like enormous asymmetrical upside.
I love it. That's awesome. Okay, so let's go back to Carta, the Carta days. So you were there from 0 to 300 million in ARR.
Yeah.
What was like the first big inflection point? Was it? I mean, originally Carta was called eShares, right?
Yeah.
And it was just doing. Yeah, tell us the story. What was Carta originally doing, and how did you guys get to that first million in revenue?
Yeah, so the early days, Henry, his idea was to replace paper stock certificates, and he was actually a former founder of a failed company. He was winding the company down, and he was talking with his investor about the paper stock certificates, and he's like, "Why isn't this online? Like, why is there actually paper here?" And that's where the original idea came up. He's like, "We're just going to digitize this and make it easier for founders to issue stock to investors and employees." But I think as he started to do that, he realized he needed to do the options, he needed to do the warrants, the convertible. And he basically was like, okay, at this point, we got the entire cap table. We might as well be the cap table management platform. So it started out as like just electronic stock certificates, and it ended up being this cap table platform. And then from there, it was like, if we have the cap table, we have the data, why don't we do the 409A? And that was a very important key point for the company. Because it really created urgency to use the Carta product. You don't really have urgency to put your cap table in the cloud, but you do have urgency to do a 409A. You have to do it like every year. And so when you need to do your 409A, if Carta offers it, you go to Carta and they say, yeah, you have to use our cap table product to get access to our 409A product. And so that created the early flywheel of customers. Very, very important to bring that 409A business in-house.
Wow. And so how did you guys get your first, 100 customers?
First 100 customers. So, when I joined, we had 0 ARR, but like Henry he did have revenue. There was transactional revenue.
Oh, interesting.
He was charging $20 per electronic stock certificate that people were issuing through the platform. My job, I converted to annual recurring revenue. Like I sold the first contract for $1,000 a year, and then I kind of took it from there. And we converted all of our customers. And so we started transactional. So first 100 customers that Henry got, he was just networking with the law firm. He was using Cooley. And so he was getting Cooley paralegals to introduce him to companies. He was building into the Cooley workflow. He was working with the paralegals. I think he had some of them on as advisors. And plus he was working with the early investors and getting them to introduce him to other portfolio companies. And so Henry did when I got there was already a small trickle of business, like walking in the door. But, it really started to take off further once we continued to develop traction. We converted the pricing model over. We brought 409A in-house. Like that was a huge inflection point for the company. And then, as we got better investors, we got more exposure through them. And there was one specific moment where the company really it had its first like real viral moment. It was when Fred Wilson reposted an article, a blog post that Henry wrote. It was called Broken Cap Tables. And Fred Wilson picked it up. It was like early 2015. And that was like our first big viral moment. And demo requests went from like 1 or 2 companies were requesting demos a day to 20 per day, like permanently from that moment on.
Wow. And so how big is the team at this point? Is your team at
Dynasty?
At Carta when you ramp 10x on demo requests. Wow. And
20 employees.
Before that, did you have the goal of like, what did you focus on to grow? Was it demo requests or just logos? Like, how did you think about growth in those early days?
Our North Star, and Henry was very good about all this, much better than we are today at Dynasty. But his North Star was like certificates signed, like stock issued. Because like somebody can onboard onto our cap table product, but it didn't mean that they were like inviting their investors and inviting their employees. And Henry knew that like if we were going to create a network effect, we had to like invite people to the platform. They had to like get access. And so we forced that. And early users of Carta, early companies, they didn't want to invite they're like, why should I invite my investors to this? They don't need access to this. And so we forced them. We gave them no choice. We're like, if you want to use the product, this is what it's all about. It's electronic stock. You have to issue electronic stock to your investors. And so the more we pushed into that, like that created a viral network effect.
Wow. Wow. And so, okay, so you have the flywheel going, you're at 5 million ARR, you're getting these demo requests. Like what point do you have to rethink go to market? Is it a constant thing
Every
or
month.
it's every month? Okay,
Every single month, just like we're doing now at Dynasty.
Yeah.
There's
How do you think about
there's
that?
not one thing. You know,
Yeah.
it was law firms for Carta. It was the 409A. It was the Fred Wilson blog post. It was like mass email campaigns. You know, it was aggressively asking our investors to introduce us to other portfolio companies, right? It's ongoing. It's for like go to market is not here's a formula, just do it. No, there's no such thing. Like anybody who says that they can do that, it doesn't exist, right?
Yeah.
Like you have to you have to keep finding, growth levers, and like you pull the lever, and you got to figure out what the next one is.
And so, how did you structure your team around that? How did you build that into the growth of the sales org to always sort of look for that next lever?
We hired aggressively. I mean, we were part of the earlier Silicon Valley group of companies where it was just, let's hire as much as we can and grow as fast as we. And it was around the time when Zenefits was exploding, and Zenefits had like hired 100 sales reps overnight. And I remember I was like, Henry, Zenefits is hiring 100 sales reps. We only have me. That's it. And so Henry was like, okay, let's start with 8. We'll do 8 at a time. And so, we hired 8, we let go 4, hired another 8, let go 6. You're always, Henry had this idea that, and he has a blog post on it. It's called How to Hire. And it got pretty good traction, like went viral. It talks about like, nobody's good at hiring. You can spend all your time trying to interview somebody, asking them all the questions that Google asks their candidates, like all the tests that they do. And in the end of the day, whether or not that person works or not, it's still probably a coin toss. It's going to be 50-50 no matter what. So instead of like spending all this time interviewing people, just hire fast and make decisions fast. Because if it's not going to work, you usually know pretty quickly. Like they may not be into the company. They may not be motivated. They don't like the people they work with. Who knows? Whatever. Everybody has different reasons for being motivated. Mm-hmm. But like, if you can tell that like it's not working out, like have that conversation early and make decisions fast. Wow. Because like as an early stage startup, you don't have time to go through a 3-month cycle. I remember actually like in the early days, I had somebody who wasn't working out, and I was talking with the executive team, and I'm like, yeah, I'm trying to coach them. And the feedback that I got was like, well, what's going to happen if you continue to coach them? Is it going to work? And I was like, I don't know. I don't think so. They were like, then make the decision today. Wow. Stop like delaying that decision. Like do it now. And so let them go that day.
Wow. And how did you think about setting goals as the company continued to grow? You mentioned the goal of the North Star being stock certificates signed. How did you think about quota for the team? And
it was always, $30,000 to $60,000 a month in new ARR per sales rep. 30 is on the low end. That's more for like a early career SDR or SMB sales rep. Mm-hmm. And then more like as they get more mature, 60, 70, 80,000. Mm-hmm. But in the beginning, it was just like, let's see if we can bring people in and they can hit $400,000 annual quota. Mm-hmm. Right. And so like the way we did it was like, I hit that number first and exceeded that number. And then like, let's replicate and see how many times I can.
Oh, interesting. So you set your own benchmark basically.
Yeah. Just like I'm doing right now with Dynasty. We just exceeded the 50K in 1 month mark.
Let's go.
And now we're like,
congrats.
Now we need another sales hire.
Yeah. Wow. Okay. Awesome. So you kind of set the benchmark and then you see how many times you can repeat it.
Exactly.
And
you create a process and then exactly. Then you go repeat it.
So how do you think about funnels now? Now sort of all this accumulated knowledge and experience at Carta, the market's changed a little bit today compared to where it was. But how do you think about getting people in the Dynasty funnel and how to optimize that?
I think there's nothing better than social media in today's world. I think that like you can go, the old world was go blast a bunch of emails out there. It doesn't work anymore. Like there's so much AI spam. Like I don't even look at my emails anymore. Like, I can't. How can you be responsive with emails and like filter out the noise? It's impossible, right? And so, social media, on the other hand, that's where people's eyes are. That's where the attention is nowadays. And for startup founders, like we know where they are. I mean, we know they're on Twitter. We know they're on LinkedIn. We know they're also on Instagram and TikTok as well. But identifying those audiences on those platforms is a little bit more difficult. LinkedIn's the easiest. You can literally target startup founders. And so it's creating content, but then also partnering with people who have audiences and getting them to talk about you through their channels. I think that's the most effective growth lever of all. If you can get influencers to talk, and we have had a lot of success with this before we started focusing on founders. We partnered with one of the largest real estate influencers that exist, Graham Stephan. We're on his channels. Like he's talking about us and telling people to put their homes in a dynasty trust. Like that was huge when we were doing that product. Now we're replicating that strategy on the venture capital side with the founders.
And how should founders think about that? If they're exploring partnering with influencers, how do you know if it's working or not? And how do you compensate people for that? Like, do you pay up front? Do you pay an affiliate fee? Like what's some advice that you could share about how to approach that?
So we paid very little for any time anybody's ever talked about us. We have, in fact, to date, I don't think we've really paid anybody yet. It's really been, this is like enterprise sales, right? You have to like crack in, tell them why your product is a game changer for their audience. You have to convince them that like this, by talking about us, it's valuable for you. It's going to create viral content for you. And we have examples of this on TikTok when we were focused more on the homeowner trust. Like we have creators whose most viral content is literally about our company. Like they're big, like 5 million plus impression organic videos about our company. And like, they haven't been able to replicate it not talking about us. Like literally just like, and so that's what we had. And then you create one and then you tell the other ones, like, look at this. You can go viral by talking about us, right? Here's good for you. Plus you create partnerships with them. If they really can be like you get them to do something on the house maybe, or maybe you pay them a little bit of money to test it out. If it works, I think it's important to get skin in the game. Like we've had influencers that invest in us. Then they want to keep talking about us because they're incentivized, right?
Yeah.
But on the opposite side, if they don't want to invest, if you can give them advisor shares, I think that's also very helpful.
Yeah.
You get them skin in the game. And once they have that, then they're going to be incentivized to tell the world about you.
Yeah, I think that's a great point. I mean, your product is adding so much value. It's not surprising that people love to talk about it and share the news of how founders can sort of take advantage of this rule that's designed to help them. And all you have to do is know about it. So I think that's amazing what you guys are building at Dynasty. So where can we find you? Where can we find you on Twitter, LinkedIn? What's your website?
Yeah, website's getdynasty.com. Twitter, Sandro Chess, SANDROCHESS. LinkedIn, just my name, Alessandro Chesser. You can find me anywhere. I'm probably going to be the most responsive on the Twitter DMs, just exactly where you DM me actually, because less people, like LinkedIn is like spam all day, right? It's hard to get the DMs in there, but like Twitter, nobody DMs me. So it's much more accessible that way.
Awesome, Alessandro. Well, thanks so much for coming on today.
Thanks for having me.
All right. Fondo.com, the all-in-one accounting platform for startups. Get your bookkeeping done, your taxes filed, and cash back from the IRS. The average startup gets $21,000 back every year. If you need help with the upcoming tax deadline, check out Fondo.com.